So welcome, friends, to tonight's investor update. It's great to see you all online, and it's also great that you can hear me now too, which is fantastic. Look, special welcome tonight for those people who are fund investors, for people who are potential investors in the Passive Income USA Commercial Property Fund, and for also interested onlookers, those of you who have been wondering what this crazy bald Steve McKnight guy has been up to over the last couple of years. And maybe it's of some potential interest in your own investing. All right, very good. I need to start with a disclaimer. General advice warning: this information is of a general nature only, does not take into account your objectives, financial situation or needs. You should consider the product disclosure statement issued by Plantation Capital Limited in deciding whether to acquire an interest in the Passive Income USA Commercial Property Fund. Past performance is not a guarantee of future performance. All right, on tonight's update, here's what we're going to be going through: the latest news on the US economy, a fund outline, and talking about how our performance has been. We had a board meeting today, and our revenue for the month of July was, again, pretty good on the basis that the exchange rate went down, made another $250,000 in the month, which is pretty good revenue. We're going to talk about the properties we've been acquiring, and we're going to be talking about how it's not too late to get involved. And I'll stop the recording pretty much at that point, but for those people who want to stay online, we're going to do a Q&A session, and I will make sure that I hang around for as long as I can to answer as many questions as possible. All right, so I wanted to start this webinar with 3 investing insights that, whether you end up investing in the fund or anywhere else, even with your own investing, hold true. And so please make sure you get a pen and a piece of paper so you can write some notes to go along. The first insight that I want to talk to you about with your investing is that you want to make the trend your friend. In property investing, there's really 2 ways to make money. The first way is to take a profit, and the second way is to make a profit. Now, in regards to this trend, in real estate, if you jump on a trend and then the market goes up, the rising market lifts your profits. If you're on a market and the trend's going the wrong way, then it doesn't matter how hard you work, that trend will carry you down. And one of the smartest ways of making money in whatever investing pursuit is to jump on a trend that's moving in your favor. And so with our investing, it's always wise to sit there and scratch our heads a bit and say, well, is this trend moving in our favor? If so, how do I get on board? The second point I want to talk to you about as far as an insight goes is that money follows management. And in regards to money following management, all too often we're preoccupied with the assets that we buy. And we look at these assets and we think it's the asset that's making us money. I put it to you that poor management, doesn't matter how good the asset is, will always underperform. Whereas if you've got good management can turn a bad asset around. So when we invest, what we want to invest in, first and foremost, is management. And then we want to make sure that the assets that we buy are good assets. If we could do that, then so long as the trend is our friend, we're heading in the right direction. And then the third insight that I want to talk to you about is really simple. When opportunity knocks, make sure you answer the door. All too often I hear about people who say, oh, this incredible opportunity, I knew about it 3 years ago and I didn't take advantage of it. And when you ask people why they didn't open the door when opportunity knocked, it's any number of ridiculous reasons. I just want you to 3 basic insights. If you just hung up now and went and did something else, at least I felt that I would feel like I got these important points across to you. What are they again? Let's start. First one's real simple. Make the trend that's right, make the trend your friend. We want to be looking for trends that are friendly and we want to jump on board. Second insight, money follows, that's right, management. A good manager is more important than a good asset, but if you get a good manager and a good asset, look out. You're poised to do really well. And the third point is when opportunity comes knocking, answer the door, all right? Don't leave the door shut. Answer the door and see what the opportunity looks like. Invite it in, sit down, have a chat. figure out whether or not it's an opportunity or a lemon in disguise, but the only way you're going to know is to open the door. And don't be afraid. See who's on the other side doing the knocking. All right. So far, so good. We all still okay? Are we all still on board? Give us a yay or a nay. Let me make sure that you haven't put you guys to sleep yet. Yeah, righto, good. We've got a yay. Thank you, team. There'll be some dialogue here, and I've got the question box over there. Let's move on. All right, part one, latest news on the USA economy. All right, the first thing I want to make perfectly clear to everyone watching this webinar is that the United States economy is the biggest economy as far as a country goes in the world. There's only one economy which is bigger, and that's the European Union, but of course that's a conglomerate of nations. So earlier I talked about how you've got to make the trend your friend. Clearly the trend of where the biggest economy in the world is moving is a trend that you want to be aware of, because where that trend moves to, whether it's up or down, will create opportunity. Obviously, ideally it would be going up and we just jump on the trend and be carried higher, but sometimes as an economy goes down, there's a redistribution of wealth, and that redistribution of wealth creates, as I say, opportunity. I want you to see that the US economy is 15.6 million, sorry, I don't even know, 15.6 billion, what is that, trillion I think it is, which, whatever the figure is nearly twice as big as China, is nearly 2.5 times as big as Japan, and here's poor old Australia down here. The US economy is 10 times bigger than Australia's economy. Clearly, this thing's the giant, this thing's the elephant in the room, and whatever direction that elephant is moving in, we need to say, well, how can we make the trend our friend? The second thing I want to talk to you about in regards to the US economy is a saying that Stu Silver, aka Uncle Zally, has alerted me to, which is this: as goes jobs, so goes property prices. Say with me, as goes jobs, so goes property prices. And what I've done for you is a little bit of research here, and I've got the unemployment data for the United States, and we can see that coming into what they call the Great Recession, unemployment spiked up from what? We'll say around 5 all the way up to 10, so it doubled. And we're only talking about people who unemployment's measuring. This doesn't take into account those people who just gave up looking for a job altogether. This is people looking for a job. And then we had a situation since the peak of unemployment in around January 2010, when unemployment has started to drift down. Notice the trend. You tell me, what's the trend in unemployment? The trend in unemployment is going down. And as the trend in unemployment goes down, it means that the US economy is starting to improve. More people are being employed as more jobs are created. Now, jobs is important because clearly to borrow money, you need income, you need a job. The more people who are employed, the more money they can borrow. The more money they can borrow, the more property they can buy. This speaks to demand. And once the excess supply is soaked up, eventually prices will start rising. Let's now look at consumer spending, and we can see that coming into the Great Recession again, consumer spending was on the up and up. We then had a period where it dipped down, and remember January 2010, if we come back here, oh, wrong way, Stevie. If we come back to this one around January 2010, when unemployment started going down, what do we think is going to happen with spending? Unemployment goes down, it would seem that logical that spending would increase. Let's see. Yes, look. January 2010, as unemployment dipped down, consumer spending started going up. Why is this important? Well, it shows you that the economy is coming back to life because people are starting to spend their cash again. As people start to spend their cash, it creates jobs, creates profits, profits get reinvested, etc., etc. All right, what I want to show you here is where consumer spending was in January 2008. Show you that it dipped down and took around here till what? It's probably nearly late 2011 before it got to the same point again, give or take, maybe mid-2011, somewhere there. But hold on to your hats, team. Look at what's happened to consumer spending recently. Are you ready? Are you set? Whooshka. Look at that. There's been an explosion of consumer spending. And why has there been this explosion? Because during this period, people stopped buying stuff, right? And so their cars were 3 years old and their clothes were 3 years old and the house needed renovating, and all this deferred expenditure, because people were losing their jobs and they weren't so sure about the economy, was deferred. Well, what we're starting to see now is this world's biggest economy and the world's hungriest consumer, those people in the United States of America, waking up from their recession-induced slumber. And the trend, remember, we want to make the trend our friend, is starting to become clearer that there's a path to recovery that is unfolding. Let's look at real estate prices, which is the fourth point I want to make. Here we come into the global Great Recession. Prices plummeted. Then we went into an area where prices started to stabilize. Notice January 2010, we're still moving sideways. Why? Because people are waiting till they're able to borrow money before they can buy real estate, might have to clean up some debts. But eventually you would have thought the decrease in unemployment and the increase in consumer spend will flow through to residential real estate prices, wouldn't you? And look, it has. Now we can identify, what's that word starting with T? Yes, trend. There is now a trend identifiable here, just taking the low point of real estate prices increasing. And certainly anecdotally, with my own investing in Florida, I've seen that. I've seen properties that I was buying cheap, go up significantly in price, double, even in some cases triple in price since I started buying them at the end of 2009. The last thing I want to show you is the index of consumer sentiment. As people become more bullish about their futures and as sentiment improves, that is a precursor to how happy people are about borrowing money to buy real estate, borrowing money to fund cars, and generally spending money rather than saving it. And we can see the cliff here collapsed coming into the Great Recession again. We can see that it started to recover a little bit, but had a little bit of a dip back down here again. But you know, blind Freddy can see that the trend is going up. It looks like we had the plummeting in consumer sentiment that had bottomed somewhere around mid-2009, and as people became more optimistic that the worst was behind them, sentiment started to pick up. All right, what's the conclusion then? Here's the conclusion. First of all, that the United States of America is the world's largest economy, and the United States of America consumer is the world's hungriest consumer, all right? We can see that this economy is emerging from recession. I haven't doctored these graphs or anything else like that. With a little bit of research, jumping in, piecing the jigsaw together, you can see how employment and consumer spending and real estate prices and sentiment, they're all correlated. They're all heading in the one positive trend. We can see jobs growth, people getting employed, and we can see spending growth. And therefore we can see, as people start to be happy about spending money and buying real estate, we're seeing the market trend return to positive growth. All right. So that's part one. Part two, let's look at this fund outline and performance. So here we go. Let me tell you about how my own investing started in the United States of America. And we need to go back in time to May 2009. It doesn't seem that long ago, really, but it is. You know, it's more than 4 years ago. Where does time fly? And it started with a guy speaking at the 2009 PropertyInvesting.com 3-day mega conference. And this guy was called Dan Eckelman. And he's gone down in folklore in our office as the guy, check after check after check, straight to your mailbox, straight to your mailbox. So, look, Dan Eckelman came out and he was talking about something called tax liens. Now, for those of you who don't know, tax liens are unpaid property taxes in the United States, similar to our rates that investors can buy and earn an interest return. And I knew about them, but Dan came out and said, well, here's your chance to get on board. You don't have to be in America to buy these tax liens. And he was promoting a training, and so I went and did the training. And then I ended up, from the training, deciding that I wanted to go over and see for myself about these tax liens. And if you ever invest in an area that you don't know, you've always got to invest your time and your effort to go there and check out with your own eyes what's going on. And so I did that. And so in October 2009, I went over to the United States of America. I went over to Florida, and Tommy was the one doing the training, so I became friends with Tommy and went to check it out. And a guy came with me. That's Shane Jackson there, and this is a photo we took from Tommy's office. There's my old laptop and my wallet, a calculator, you know, Tommy checking things out, and there's Shane right there. And we worked out at Tommy's office, map over here on the wall, and we charted going and checking out these tax liens. I wanted to drive by the properties and see the actual properties that these tax liens were on. And as we drove around, we saw some incredible sights, you know, houses with that weren't finished. The global Great Recession came along and they never got to finish them. I mean, look at, I don't know if you can see it on your screens here, but there's a big vine growing up over the front door, and grass, and houses that were, windows that were boarded up and overgrown, and signs on properties, dangerous building. A lot of these were just left vacant as people just handed back the keys and disappeared to go and try and find employment elsewhere. And then the most shocking thing of all were these letterboxes. I mean, who has a letterbox like a sea cow, right? So you see some things that you never want to see, and some weird and wacky things when you venture over to the United States of America. Anyway, to cut a very long story short, as we were driving around, we drove past this property in a place called Pine Manor, also known by the locals as Crime Manor. And this was a property that had tax liens available on it. But in looking it up, we also, Tommy and I became aware that it was actually for sale. Now, this property was valued for property taxes in 2009 for $32,650. This is a duplex, 2 properties, one at the front here and another door at the back there. And we ended up buying this property. Remember, it's end of 2009, and we paid the grand sum of $12,500 for a duplex. Rented $450 front and back per month. Ridiculously positive cash flow, even after we chipped in around $21,000 renovating it. And I couldn't understand why more people weren't jumping on this opportunity. Massive positive cash flow. Prices down, prices are down. And to me, it was this incredible opportunity. So I started buying everything I could on these crazy yields. And I came back to Australia, and at the market updates that I do, I was telling people, look what you can do. You've got to get on it. As the market comes back, you know, you won't be able to buy property for these kind of prices. And in the meantime, you're getting positive cash flow besides. So what was this opportunity that I saw knocking in 2009? Positive cash flow, as I was saying, growth when the economy bounced back, and the Australian dollar was having a bit of a bull run. It was around 90 US cents, which I remember buying the US dollar when I was over there visiting my brother at 49, nearly 50 cents. And so 90 cents was this incredible buying opportunity that I thought, well, why the dollar's so high? We've got to be doing something about it. So let's fast forward to today. What did I do? Well, I went and bought around 200 properties, a mixture of single family, multi-family, mobile home parks, with my team over there in the United States, with Tommy Senator, who's my US investing partner, and Aaron Dunlop, who some of you may have met. That portfolio now throws off net US $17,000 per calendar month. And doing a quick tally, I estimate that those properties that we've bought have increased across the portfolio by around $1 million. And if you average that out for the days I've owned this property, every day I've woken up to about another $713 of capital appreciation. That's the power of letting the trend be your friend. That's the power of when opportunity knocks, opening the door, and that's the power when you find one of these great opportunities and put a management team in place that even if it's on the other side of the world, you can still take advantage of it. So here's my question. I want you to answer it. Who wishes that they jumped on that train with me in late 2009, early 2010? Yay or nay? Type it in. Who wishes that they were on that train back then when property prices were so cheap? All right, Maria, yep, Colin. So you guys can see it, right? This is the thing about a trend. It's so obvious in hindsight, but people can't see it even when it's laid down there in front of them. I mean, I've shown you the graphs today. I've shown you the trend. I've shown you sort of the opportunity, and people say, oh, but, or, oh, I don't know, or, people come up with excuses for why they don't jump on board. Well, friends, I've seen trends in my time. I've seen trends in Ballarat with cheap property prices. I told people about it. A few people got on board, most didn't. I saw trends in New Zealand I told people about. I was running Kiwi Adventures back in the day, taking people down to New Zealand and saying, why don't you go and buy some properties and I'll be there to help you. And not many people jumped on board. And I was telling people about it in 2009, I'm in market updates begging people, please take advantage. If you haven't before, opportunities like this don't come around too often. And lots of people still did nothing. It's frustrating when you lay things out for people, but they keep doing nothing. How many opportunities have passed you by? How many times has opportunity come knocked on your door and you've been too afraid to open it for fear of what's on the other side? Sorry, I've got to work myself up here. I'm talking to a computer screen. I know that there are hundreds of people listening to me at the moment, and there'll be more people at home watching this in the recording, but I've got to pump myself up for excitement. It's sort of hard to read the room when you're talking to a computer screen, so I hope you'll forgive me if you think I'm being a bit over dramatic here. All right, so maybe you missed out on that first opportunity. So then let's move on and talk about part two, which was a second chance. All right, so we're talking early 2011. The US economy had started to stabilize. So I was making trips over there to check out my own portfolio. And as I was making trips over to check out my own portfolio, what I found was the economy improving. There were jobs being created, more cars in the shopping mall car parks. Talking to people, they weren't, talking about how pathetic it was. People were talking about, maybe getting jobs or property prices stabilizing. In fact, residential property in around 2011 hadn't just stopped going down. What was happening is when properties were being listed, there were multiple offers, and properties started to sell faster and started to sell above the listing price. The Australian US dollar was smoking hot. We were well above parity, $1.05 moving into $1.10. And I was asking myself, well, this residential real estate opportunity looks like it's coming to an end, or it certainly wasn't as sweet as what it was. And as I always do, I was wondering, where's the next opportunity, right? So if that one's starting to come to the end, where's the next opportunity? Where's the next mine? Where's the next gold mine? Where am I going to find my next great profit? And the answer to me was commercial real estate. Why commercial real estate? Well, although residential property prices had started to increase, residential property prices had started to increase, commercial property was still the unloved cousin. Why? Because there's usually a lag of 12 to 18 months between residential prices going up and commercial property prices going up, because it's got to filter back in, profits have got to filter back into businesses, be recycled and start to get some margin before businesses want to invest in new premises, right? The yields were high because prices were low, and you could still negotiate great deals because there weren't that many buyers out there. To me, it was the logical next thing to go up in value. I'd seen the commercial prices stabilize. I'd seen the economy started to improve. And I thought, well, everything else being equal, the next trend that I see that could be my friend is commercial real estate. So what was my vision? Well, the problem with commercial real estate is that it's expensive, right? And so it was too big for me to do on my own. I wanted to grab a hold of the trend. I could see it forming, but I couldn't do it by myself. So what I wanted to do is I wanted to establish a managed fund to go and buy US commercial property. Not just any fund, though, a fund that combined my two passions of real estate investing and education. So some people can sing, some people can dance, some people have a beautiful head of hair. Unfortunately, I can't do any of those things. It seems that one thing I'm good at is property investing, and the other thing I'm good at is educating people. So I didn't just want to do an AMP fund. I'm not interested in that. What I wanted to do is do a fund where people who have been clients of mine and have watched me invest, and many of them have said, Steve, if you do anything, let me know. I want to jump on board. You seem to be pretty good at this, and I find all these reasons why I don't do anything. How about when you find the great opportunity, when you find the mine of opportunity, what about you take me with you? What about we do it together? And I said, no, not interested. I'm no one's water boy, right? I do my own investing, and I'm happy to teach you and I'm happy to help you, but I didn't want to do it for you. And then this opportunity came up for commercial real estate, and I thought, well, the only way that I can get on board is if we do it together. And so perhaps in a moment of madness, I went and set up a regulated investment scheme or managed investment scheme here in Australia. And to me, it's the mine. It's the mine of opportunity. It's your chance to come with me to the mine and then watch as an insider as we mine this opportunity of commercial real estate together. I don't need you to do anything, guys. I don't need you to get into the mine with your pickaxe. I don't want you to do any work, right? This is a passive investment fund. What you have to do, though, is come with me into the mine. Right? You've at least got to be there with me so I can show you the opportunity. I want to take you to the mine while it's still open. And so what was the opportunity? Cash flow, because, I'm Mr. Positive Cash Flow. I didn't want to buy any negatively geared property. Capital gains, as similar to what I said before, as the market improves and commercial rents start going up, commercial values start going up, and foreign exchange upside. I wanted to get involved in doing this while the Australian dollar was still above its long-term average, and ideally while it was reasonably hot, smoking hot if possible. And as I said, I didn't just want to do it for people. I wanted to use it as a teaching tool to show people a side of investing practically as a partner to make it real. And I was really passionate, and am really passionate about using this fund to open opportunities and open your eyes to how to become a better investor. So here's how it works, right, really quickly. You are the investor. You invest your dollars in the Australian Managed Property Fund. And in return, you receive units in the fund. The Australian Managed Fund then takes that money and invests in a US real estate investment trust, which is called Aussiness Realty LLC. Aussiness Realty then, through a sub-entity, because for asset protection we only put one property in one LLC, takes that money and goes and buys real estate, receives back rents and capital gains eventually when it's sold. The REIT then pays that money back to the Australian Property Managed Fund by way of a dividend, and then the fund then pays a distribution back to you. How often are the distributions? Well, we target to do a distribution every 6 months. And so casting this amazing vision, right, of setting up this managed fund to go and buy commercial real estate, we had a go-live date. I put hundreds of thousands of dollars of my own money, months and months of time, getting this available so that we could all be a part of it, and we launched it in June 2012, right? And in June 2012, when we launched it, the issue price was $1 per unit. Pretty simple. And we had to raise $20 million by the 31st of December 2012 to make it worth our while, because we needed a minimum critical mass. Otherwise, we weren't going to cover the costs of running the fund. And 20 million was our break-even point that we had to reach. All right. So what were the outcomes? How did we go? And it was a big leap of faith, because I couldn't tell people the potential earnings because I wasn't allowed to, and I couldn't tell people what we were going to buy other than commercial real estate because we hadn't bought anything. So really what I had to do was I had to go to the market and say, look, I've got this track record of doing well in real estate. Trust me, it's going to work out okay. All right? That's really all I could say. Well, luckily, trust was a commodity that people were willing to invest in, and we raised the $20 million by the end of October 2012. And for those people who were foundation investors, I can only and will continue to say thank you from the bottom of my heart in order for backing me up here, or backing me in. We then suspended new applications on the 31st of December 2012, and we'd raised $27.5 million. Why did we suspend it? Because we wanted to stop the administration so we could then go and grab that money and go and invest it. Now, who would like to see what we've done with that money? Who would like to see what we've gone and bought? All right, we've got a couple of people saying yes. So, all right, good. You're still with me. I want to make sure you're still awake. Keep me awake as well. All right, in order to show you what we've bought, I need to give you another disclaimer. Bear with me. Information provided about forecast annual net cash flow and cash-on-cash returns are derived from unaudited financial projections. Such forward-looking statements are not guarantees of future performance and involve known and unknown risks, uncertainties, assumptions, and other important factors, many of which are beyond the control of the responsible entity. The responsible entity cannot and does not give any assurance that the results, performance, or achievements expressed or implied by the forward-looking statements will actually occur, and investors are cautioned not to place undue reliance on these forward-looking statements. All right, here we go. Here's the very first property that we ever bought. This one is in Fort Myers, Florida, and Hanson Street. Now, do you think I prefer to buy pretty properties or ugly properties? Let me know. Do you think I would be doing pretty or ugly properties? Well, Tim says ugly, Colin ugly, Annabelle ugly, ugly, ugly. Everyone's saying ugly. Hang on a second. I don't care if I buy ugly or pretty so long as they make money. And ideally, if they're pretty and making money, they're better than ugly than making money. But what I want is something that makes money. It just so happens that this first property is a little bit on the ugly side. All right, here it is from an aerial. You can see that it looks pretty much like a box, a rectangle, and it's divided up into 5 tenant spaces. There's some area out the back here as well, some extra storage. Looking at the property, we bought it for $620,000. We bought it in March 2003. 7,432 square meters of land. When we think about land, maybe sometimes people aren't spatially aware. A good way of looking at this is to think about what an average house lot size is in Australia. It's around 600, 700 square meters. So this is around 10 average house lots in size, so quite large. The building itself, 23, 22 square meters, and it's 5 tenant spaces of 500 square foot each. All right, looking at the numbers, I'll just move myself up a little bit here. All right, looking at the numbers, the forecast annual net cash flow, 59,904, purchase price of 620,000, times by 100 gives you a cap rate of 9.5% net. All right, now you tell me, who's happy or who would be happy to get a 9.5% net cash flow return on their property investments? All right, Simone says sure. Yeah, all right, Collins, yes, Felicity, yep. All right, so think about this. Try and find a 9.58% return in Australia, net. It's not it's not something that's readily available. Now, here's the deal. Because we're investing in US dollars, if the exchange rate goes down, as it has, for every US dollar, we get more Australian dollars. So our 9.58%, if we took I've lost myself, let me bring myself back. If we took an exchange rate at 90.49, which is what the exchange rate was when I did the calculations, then our 9.58 goes up to 10.58. So we make money because one American dollar buys more than one Australian dollar, which is one of the advantages of investing in a fund like this. So hopefully 10.58% would be good, but we want to do a little bit better than that in time. So what's going to happen is that if we, and we haven't done this, but if we assume that we could finance 40% of the value of the property on a loan at 5% interest only, then our cash-on-cash return, we get a little bit less income because we've got interest now, but our cash down goes down, the dollars we've got invested in the deal, which means our cash-on-cash return goes up to 13.3%. And after we do the exchange rate, we now sit on a return somewhere around 14.7. Who's happy about 14.7? All right, Colin's saying better with a smiley face. All right, so now we're starting to get a couple of thumbs up. Good. And remember, this is only the cash flow return before rents have gone up, assuming the commercial property market picks up, and before a dollar of capital appreciation. All right. So these are might be an ugly property, but all going well, it'll be a really good cash flow property. So let's look at another one. This is Breckenridge in Clearwater, Florida, which is in the Tampa Bay region. And here's an aerial of this, and you'll see there's 1, 2, 3, 4 buildings. Now, the sorts of properties that we're targeting in the fund are known as flex, F-L-E-X, flex spaces. And what flex spaces means, it's short for flexible spaces. And we're targeting these kind of properties specifically because the classic American business that started in a garage, as it gets bigger, as it grows, moves out of the garage and into one of these little flex spaces. It's like mini storage, but instead of storage, you have small to medium businesses operating out of it. So this property had a purchase price of $2.9 million, bought it 26 April 2013, big plot of land, right? 17,000 square meters. 5,146 square meters is the building size or area under roof, and it's got 40 tenant spaces. All right, looking at the annual forecast cash flow at 80% occupied, this property came with finance, $1.16 million at 3.5%, vendor carryback finance, interest only for 5 years, gave us income of $179,953 divided by a cash down 1.75, which gives us a 10.28% cash-on-cash return, or after the exchange rate, 11.36, and that's with 20% vacancy. Clearly, as we start renting this thing, and hopefully we'll get into the 90s, 95, I mean, all going well, we may even get to high 90s or 100%, then our cash-on-cash return is going to go a lot higher. So another good property, right? Let's look at Pinellas Park over there in Tampa Bay as well. This is a much prettier building, right? A very pretty building. 3 tenant spaces, a little one over here on the side and one in the middle and one on the far end there. And this property was bought for $1,095,000, bought on the 3rd of May 2013, 4,667 square meters, 2,197 square meters of building size with 3 tenant spaces. Bought it with forecast annual net cash flow 103,186 divided by a purchase price of 1,095 gives us a cap rate of 9.51%, after exchange rate 10.5. Then if we financed it, our income goes down to 85,666, but our cash down's 372. Gives us a cash-on-cash return of 13.404, or after exchange rate 14.41%. Now, I don't know what you guys expect out of an investment, but an investment that gave you 14.41% net plus capital growth is a pretty good investment, if you ask me. And if I could buy properties in the fund that were like this, we'd just high-five each other down the road until the road ran out. All right, here's another property that we bought recently, okay? This one is Palmetto Grove. This is in Fort Myers, Florida. Flexible space again, 1, 2, 3, 4, 5 buildings. All right, purchase price of $2 million even. Purchase date 15 August 2013. 18,000, nearly 19,000 square meters of land, 5,700 of building, 27 tenant spaces. Estimated annual net cash flow. So we're doing cash-on-cash return here. Finance is $600,000 with 4% interest over 20-year amortization, balloon after 5 years. Gives us a cash-on-cash return of 9.87 or 10.91% with the exchange rate. Great property. The sort of property which is a better quality property. And so the return might be down a little bit, but as rents go up and as vacancies are filled, cash-on-cash return will go up as well. All right, here's the other property that I want to show you. All right, this one's in Dallas, Texas. Now, what do you think of this property, folks? You saw the first property I bought in the United States of America, that little duplex for $12,500. Have we come a long way? You betcha. All right, and this is in Dallas, in Texas, a really smoking hot property market. Purchase price, $3 million, right? $3,050,000. Bought in August 2013. 8,514 square meters of land size, 4,742 square meters of building, and it's a 4-story office building, multi-tenant, right? It's got a good anchor tenant on the bottom, a credit union with a drive-in bank. All right, forecast annual net cash flow, 356,241 divided by purchase price gives us a cap rate of 11.68, or after exchange rate goes to 12.9%. All right. What about if we were able to finance 40%, LVR 5% interest only. Our cash-on-cash return goes to 16.8%, or after exchange rate 18.57. All right, that's what I'm talking about. Now, don't expect these kind of trees, or this kind of deals to grow on trees or fall out of the sky. All right, it's a very good property. It took a lot of work to find and get it over the line. But how about it? So for those of you who want to know how we're going, the audit for the year end 30 June or period end 30 June 2013 is almost finished. Our operating profits, this is unaudited, for the period to June was $2.2 million. And remember, the fund only really started getting going on the 1st of January after we raised that money. So to be able to make $2.2 million between January and June in a startup fund, what do you think? I'm going to pause until people say comments. I'm not sure what people were expecting, but to be able to make not only 1 million, 2 million bucks in our first 6 months, right? I mean, praise God. It's an awesome outcome. All right, so unit price, remember units were issued at $1. The unit price as at 30 June 2013 was $1.77. The unit price at the end of August was up into the mid-$8s, and we haven't quite got the numbers just yet for the end of, that was July, for the end of August, but my guess is that we'll be somewhere in the $9s come August, come the end of August. So for those of you who came with me to the mine, I'm pleased to have been able to, at this point in time at least, repay your faith and to show you that, again, money follows management, and when you jump on the trend, a friendly trend will just carry you upwards. All right. The total US property that we bought at 30 June 2013 was 4.615 mil. We're about to cross over 10 million bucks of property bought, so we've really accelerated the rate at which we're buying real estate as we're getting more momentum and lots of property in the pipeline. Total assets at 30 June was just shy of 30 mil. So fast forward to the 2nd of December 2013, the property that we'd acquired was 9.665 million. Like I said, next week we've got a property settlement that'll push us over 10 mil. We've got another 6.8 million under due diligence at the moment. Most of that's actually looking pretty good. And we've got under offer another $31.2 million out there in the wild doing negotiation on it. So there's a fair bit happening for those of you who've invested in the fund already. All right, so I'm going to ask you again as I take a little sip here, with the benefit of hindsight, who wishes that A, they had have got on board if they didn't, or if you did get on board, who wishes that they had have invested more money? Come on, time of honesty. I'm going to sit here. All right, I've got 2 people saying yes. We had 3, 4. All right, some people saying yes, glad they were on board. Guys, there are no certainties in life, all right? Unfortunately, there aren't. But I've been investing for long enough now to be able to know that when you find a friendly trend, don't argue with it. When the opportunity knocks and you open the door and there's a bag of cash there, don't shut it again. Get on board, all right? Take me to the mine. All right, part 3. It's late, but it's not too late. Who wants me to take him to the mine? I need you to say it. Take me to the mine, Steve. Colin says yes. Take me to the mine. Take me. All right, thank you, Anthony. Take me to the mine, Steve. Here we go, guys. I want to take you to the mine while it's still open, all right? Time's marching on. You know that the Australian dollar's gone down. My own feeling is that it's got further to go. Particularly as the US economy strengthens. I mean, people will want to invest their money back in the US economy as US interest rates eventually start to go up again. The Australian economy is off the boil. The trend is not your friend in the Australian economy at the moment. All right, you want to jump on where you go on the friendly trend. So I want to take you to the mine while it's still open. If you'll join me, you don't have to do anything. All right, you just got to come with me though. Got to take action. just about a month ago at conference, I launched the release of 22.5 million. I wanted to go from 30 to 50 million basically. And one of the reasons why I wanted to go to 30 to 50 million is that the complexities of international tax mean that we can only invest 10% of total amount of money we've raised in any one deal. And so I wanted to go from being able to buy properties with a cap of 3 million up to properties with a cap of 5 million. Why? Because the $3 million market's starting to get a little hot. If we can go up to the $5 million market, there are less buyers in the 5 million market than the 3 million market. So what I encouraged and what the board ratified was to do a new capital release of up to 22.5 mil. And already 40% of that 22.5 million was allocated by people who were already in the fund saying, Steve, we want to top up, we want to put more in. We've seen what you're doing and we took a nibble first time around, now we want to jump on board. And then I released it at conference and that 40% went up to 50%. And I think at last guess, now we're somewhere close to 60% of that allocation being pre-allocated to people saying, yes, I want to jump on board. Take me to the mine, Steve, while it's still open. So I want to give you the opportunity to get your slice. And I want to give you the opportunity to get your slice before I do my market updates in the middle of October. Because my feeling is once I go around the countryside and show people this at market updates and talk to hundreds and hundreds of investors, again, this opportunity is going to end, guys. And people are going to be shut off like they were last time when we raised our money, saying, Steve, we're ready now, we're ready, take us to the mine. So unfortunately, the tour's over. All right, I'm in the mine. And if you're not in the mine with me, sorry, you're not allowed in. So if you want to join me in the mine, here's your opportunity, all right? Please don't allow this opportunity to slam shut again. Let me talk to you about what the opportunity is, all right? So the opportunity is to go and invest in commercial property in the United States of America. It's not free. It's not a free opportunity, right? There are fees associated with doing it. And the first fee is a contribution fee, and the contribution fee is 3.96% of the amount you invest. What is this contribution fee? You are paying me to take you to the mine, to let you into the mine in the first place. It's your price of admission, if you like. So if you were to invest $100,000, you would pay me $3,960 for making this opportunity available to you. What does that buy? Well, it pays me for my risk and my effort, the months and months of work and the hundreds and thousands of dollars that I put in to make this opportunity available. And the second type of fee you need to be aware of is a management fee. And the management fee is 1.98%. Including GST, of the gross assets of the fund. Now, you don't pay that directly. The fund pays it, unlike the contribution fee where you do pay, and then we issue units out of what's left. The management fee is paid out of fund assets, but what it effectively does is decreases the amount of distribution that you would otherwise receive. So who can invest in this fund? Who can come to the mine with me? Well, individuals can come on. Sorry, there's a question I just saw. The contribution fees are once off, right? You pay it when you make the investment. The management fee is per annum. So thank you, Maria, for asking that. So who can invest? Individuals can invest, 2 or more people together. Partnerships, if you've got a formal partnership. Companies, if you've got a company. Trusts and self-managed super funds. And on that, a large number of self-managed super funds are investors in the fund because they're buying an Australian asset, which is the units. So yes, they get exposure to real estate and offshore real estate, but it's essentially an Australian managed fund, and that makes it quite easy to audit. So what I want you to do right now is based on what I've talked to you about, and I realize you've got to read the product disclosure statement, but I want to know how serious you are about joining me in the mine. So everyone who's listening here right now, I want you to type in a figure between 1 and 10 about how interested you are about joining me. 10, 7, 10, 8, 8. Please, everyone who's listening, put in a figure. All right, so most people are, all right, some 6s coming in now. All right, I'll give you a couple more minutes, a couple more seconds, some 5s. All right, 1,000. All right, good. Thank you very much. Here's what I want you to do, right? If you rated 1 to 6, right? If you gave me anywhere between 1 and 6 about being interested, I don't want you to invest in the fund, all right? Please. Thank you for your interest in it, but don't invest. I don't mean to be offensive. It's definitely not my intention. But I don't want to take people to the mine who are lukewarm. I don't want to take people in the mine who are always looking over their shoulder going, I came, but I came because I sort of had to. I want people who are going to partner with me on this, who are passionate about the opportunity, who are passionate about having me take them to the mine and show them how to do it. I want people who 5 or 10 years from now will look back on this and see this as one of the best investment decisions they ever made and be proud about how passionate they were. So if you rank yourself sort of 1 to 6, thank you for your interest, but please don't invest. And there's no hard feelings at my end. If you rated yourself a 7 or 8, then I encourage you to find out more information to get yourself up to a 9 or a 10. And if you rated yourself a 9 or a 10, then all I can say is that I will do everything in my power, absolutely everything in my power, to make this the best investment that you're ever associated with. Obviously, my integrity is on the line. I'm working harder in this than I've ever worked in anything in my life. Just so you know, at the moment, I tend to work somewhere between 50 and 60 hours a week, and most of those hours are on the fund, getting this going, managing it and managing the teams, because I believe that money follows management. And so it's a pleasure for me to be able to have already got the results that we've got on the board, shown you the properties that we've bought. And all I can say is that I'm aware that people have invested their money in me as much as even the opportunity. And I want to show you the money. I want to show you that your faith in me has been well placed. So the only way I can do that is with some time, but already we're starting to see some good fruit, and I'm hopeful that that good fruit will continue. All right, so the question that people who sort of rated this 7, 8, 9 or 10 ask me is how much should they potentially invest, and what are people investing in the fund? And to try and give you some idea, let me say first of all that the serious investors, and obviously it's how much money have you got to invest, but the serious investors invest 6 figures or above, and I'm one of these serious investors. I've got a significant amount of skin in the deal. All my superannuation money is invested in this. I've also borrowed against our home to invest in this. I have skin in the deal to want to make this work in a big, big, big way. I'm not the fund's biggest investor. I want it to be. I think there's 1 or 2 people who've invested more money than me, but there aren't many of them. If you're a mid-range investor, all right, $50,000 plus, and if you're a get-going investor, $10,000 plus, my fear, right, speaking candidly, is that if people want to take a little nibble at this, this isn't a linear opportunity, all right? It's not a straight line opportunity. The best opportunity with this fund will occur in the early days as the market rebounds, as that capital growth bounces back or snaps back to where it should be, as rents reset. That'll be the big kicker in growth, in my opinion. After then, once the market's stabilised, there'll still be growth, but it won't be the big growth. So I can't give you any kind of earnings forecast, but I can tell you anecdotally that I believe that the most growth, when growth happens, will happen in the early years of the fund rather than the latter years. I mean, you've already seen what's happened to the unit prices. The Australian dollar's gone down. We've gone from $1 to nearly $1.08, $1.77 at the end of June within 6 months by the exchange rate alone. As property starts to go up, then the values will go up as well. So it would be a shame, if you ask me, for people to be a little nibble investor, then go, okay, I've seen the light, Steve, it's reflected off your head long enough now for me to believe it. I'm ready to invest more money. And A, they can't because we're not accepting any more money. Or B, they're buying in at a much higher unit price because that big chunk of capital appreciation has already happened. I mean, people are already paying 8 to 9% more 6 months down the track to what they could have bought at last year. And then if you already invest in the fund, if you're already an investor and you want to top up, because you are already an investor, your minimum top up is $5,000. All right, so be aware. What you have to do is read the PDS. All right, here's what the PDS looks like. Let's see if I can find one for you. It should just be over here. I tied up my desk. Here we go. Here's what a PDS looks like. All right, now you can get a print version of it like this one, or alternatively, you can download it off the internet, and I'll give you the link in a second. You need to understand that this is not a liquid investment. All right, so if you invest in it, you are a medium to long-term investor, because we're going to go invest in bricks and sticks. So if you put your money in this month and said, hey, I want it back, it's invested in real estate, so it's not liquid. And that's why we say that we're not going to honour any redemptions before 31 October 2015. Okay, team? Why? Because we want to go and invest that money in real estate. But if you want your money back after 31 October 2015, so long as we've got the money to give you, then we'll honour the redemption. And the details of the redemption are included in the product disclosure statement that you should read. All right, now let me try and sweeten this for you, because the first time round when people invested in the fund, I gave them a 50% discount on the contribution fee. This time around I can't be quite as generous, but I do want to reward those people and offer you a 25% discount to the normal contribution fee. After we get to 50 million and we shut the fund off, when we open it for the final 25 million, because we've got a cap of 75 million, there'll be no discount on the contribution fee. Trust me on that. All right, so if you want to get a 25% discount on the contribution fee, which depending on how much you invest could save you hundreds or thousands of dollars, then here's what you've got to do. You must register your interest today. You've got to tell me how much you want me to set aside for you. And the reason why I have to know is because as I plan for these market updates, I need to know how much is left so I don't give people false hope. Now, it's no obligation. You can change your mind after reading the product disclosure statement, no worries at all. But I need to know for my own internal budgeting how serious you are about investing and how much of that 22.5 million that's available you want me to carve out and make available to you. Then, right, you must send me a completed application by the end of September. All right, a top-up form if you're an existing investor, or a new application form if, a top-up form if you're an existing investor, or a new application form if you're a new investor. All right, so let me just re-summarize again. If you want to get a 25% discount on the contribution fee and save hundreds or thousands of dollars, depending on how much you invest, you've got to register your interest today, and then you've got to send me a completed application form by the end of September. You don't necessarily have to send me the money if you're setting up a self-managed super fund. If there's some problem, you're waiting for something to happen, I can give you until the end of October to get me the money, but I need your application form by the end of September. All right, now another reason why you might want to become an active investor ASAP, which means getting your application form and your money, is because you'll get to attend the next investor fund update. So I do 2 investor fund updates a year. I did the last one in Melbourne, the next one's in Sydney, all right? It's on the 13th of October, and it's free for fund investors. Or if you can't make it to Sydney, we stream it out over the internet, much like I'm streaming this webinar right now. And the reason why you will want to participate, I think, is that we have a very, very special guest who will be joining us at the live investor update. And you know who that very, very special friend will be? It'll be Uncle Zally, coming to talk to us about how the US market's going, how the fund is going, and how our tenants are going. So I hope you'll be able to make it. It's going to be fantastic if you can. Remember, it's only open to fund investors who are active current investors at that time. All right, so I started this webinar today and I talked to you about 3 things. First of all, with your investing, you want to make the trend your friend. And I believe firmly in my bones, in my investing bones, that US commercial property is a great trend to be on, all right? While it lasts and we get that recovery in the market. We want to be there now. The second thing I said to you is that money follows management. And for years, people have been saying, Steve, you seem to be good at this. Can I give you your money? Will you invest it? Or can you do something and we can be a part of it? And I'd said no. because I was too busy doing my own investment. And now I said, yes, I want to take you to the mine. And I appreciate that people said, take me to the mine, Steve. We want to be a part of it. Now I can show you how we're going in the mine. I can only ask that you back proven management. And if you believe that money follows management, then good management and good assets will drive a good return. And then when opportunity knocks rather than knows, when opportunity knocks, make sure you answer the door. All right? Opportunity is knocking right now, team. All right? It's knocking right now. Will you open the door? Will you do something about it? All right. So, friends, you've got a choice. You can join me in the mine, or alternatively, you can join the line. What is the line? The line is the line of regret. It's people who look over their shoulder again and again and again and keep saying, I keep missing out. I keep missing out. When's it going to be my turn? When am I going to do something about it? Well, friends, your choice, the mine or the line. If you would like to register your interest, and remember you've got to do it today to get the 25% discount on the contribution fee, it's really easy. All you need to do is go to PassiveIncomeFund.com/ROI. There'll be a web form to you to fill out, and depending on how you answer it, whether you say you're a current investor or a new investor, you'll be directed to the right web page with instructions on how to invest. All right, very simple. If you've already done an expression of interest by filling in a card, or you've gone to this website, you don't need to go again. All right, it's only for people who haven't expressed an interest thus far. All right, so what we're going to do now is we are going to do a Q&A session. I will press stop record so that we can get the video up and ready ASAP, but I will stay online and answer any questions that you have. For those of you who are watching this afterwards, up until we get the required amount of money, all I can say is that go to the website and check out whether or not this is still available. All right, PassiveIncomeFund.com/ROI. Check it out, register your interest, and I look forward to joining, or to have you joining me and the other people, the 700 or so other investors who are already in the mine. All right, folks, if you need to rush off now, thank you very much for watching. I hope it's been an insightful hour for you. If you have any questions, please hang on and I'll be online to answer them. If you are hopping off, thank you again. Until next time, all the best and bye-bye for now.